What's up, guys? Welcome back to another video. In this video, we're going to be talking about which option contracts you should choose. A lot of people think, oh, I think this is going to go up, I think this is going to go down, let me just choose a random contract. But it's a little more than that. You have to choose a good contract, and that's what we're going to be talking about today, right? We're going to go into just a little bit of terminology, a little bit of definition, and then we're going to talk about what I like to do as well. So let's get to it. So which option contracts should I choose? First, and most importantly, you cannot choose an option contract that is outside your budget. If you cannot afford it, you should not buy it. You should not try to buy it. You should not invest your whole portfolio into one trade, into one contract, no matter how much or how little you have, because if that play goes bad, you will lose everything, right? You're at risk of losing everything, and you never want to put yourself in that position, right? So the other factors that will determine what's a good contract for you, or just in general, are the Greeks and understanding what volume and open interest is. So the Greeks, to keep it simple, the Greeks give you a measure of an option contract's potential. There are three different types of Greeks that we're gonna focus on: the delta, the gamma, and the theta. So the delta, this Greek has the biggest impact on an option's value. It estimates how much an option contract will increase for the first $1 move. And the delta has the power to increase and decrease depending on the movement of the stock. Let's go over an example. So to our right, we have the Apple 141 call expiring July 9th. So the delta for Apple is 0.36, right? You can see it right here. It says the Greeks. This is just a quick screenshot of Robinhood. This is a very old screenshot, so don't look at it right now. But so as you can see, the delta is 0.36. This means that if the share price of Apple increases by $1, then we will see a $36 profit per contract that we own. So holding one contract, we will see $36 profit for the first $1. If we add 10 contracts, we would see roughly $368 profit for the first $1, right? You get me? And as the share price goes up, the profit goes up. So if you wanted to, say you just were experimenting or whatever, you're getting a feel for it, you go and buy this $141 call expiring July 9th with a 0.36 delta. You buy one, the share price goes from 140 to 141. Your option contract is now $36 more valuable than it was before based on this delta. So the gamma, this is used to determine the rate of change for the delta. It really just complements the delta starting after the first $1. So quick example, to calculate the gamma, all you do, pause, just really quick. This is not something, we're not doing math while we're looking at what contract to buy. This is just something you need to know, so you can really you can look at the contract, you can look at the details of the contract, and then just move forward. We're not going to be pulling out a calculator to see what type of return we will get on this, that, and the third, right? Because by the time that, you may just miss the play by then. So let's get back to it. So to calculate the gamma, all you do is add it to the delta for every other $1 increase in the share price after the first. So I know that sounded confusing, but we're going to break it down. We're going to break it down, I promise. In this situation, to the right, the gamma is 0.12. After the first $1, the delta gives us a $36 gain, right? We went over the previous slide. This is the same contract. We got the $36 gain after the first $1. The next $1 and every other $1 after, we take the delta plus the gamma, add them together for our potential gain. Next, we have the theta. The theta represents time decay. So the closer a contract gets to its expiration date, the less valuable it becomes. The farther away from your expiration date, the less intense the theta will be. Let's break down what that means. So in this example, the theta is negative 0.11. Like I said, it's time decay, so that's why it has a negative sign right here. So we have negative 0.11. This means that every day the contract is held, regardless of the share price, it will decrease in value by $11 each day. Generally, we want the theta to be as low as possible. However, if the charts look good and the share price increases with a good delta and gamma, the theta shouldn't be such a big issue. So say you have a good delta, good gamma, whatever, and the share price runs a lot, right? It runs a lot. That $11 deficit isn't really gonna bother you much. Like, who's gonna really care about $11 when you made hundreds or thousands on the other side, right? Next, we have the volume. The volume refers to the number of trades completed each day and is an important measure of strength and interest in a particular trade, right? Varies contract to contract, the higher the better. Now, this is where different strategies come into place, right? So for me, I always like to trade stocks. Not only stocks, but trade option contracts that have extremely high volume. Why is this? That is because I like to day trade, right? And when I day trade, without this volume for the contracts, like as you can see, the volume is 28,000. Without that volume, it may be a little more difficult for me to be in a heavy position and then sell that same position, maybe minutes or maybe an hour later, right? If the volume's extremely low, then I'm gonna have a hard time finding somebody on the other side of the trade to come take buy this position off of me, the one I'm trying to sell. But if the volume is like something like 28,000, which is absolutely insane, then I could buy and sell this contract relatively easily because there are so many trades happening at that moment. Next, we have open interest. I treat this the exact same way as the volume. I want the volume to be super high. I want the open interest to be super high, especially when I'm day trading. When you're swing trading, it could definitely, it doesn't have to be crazy high, but when you're day trading, you're gonna want the volume and open interest for your contracts to be really good. Open interest reflects the number of contracts that are held by traders in active positions. Like the volume, like anything, it varies contract to contract, but the higher the better. Just like you want volume, open interest. Those are my top things. Like when I'm day trading, I want the volume and open interest to be super high. And because when I'm day trading, I don't need to worry about the theta, right? I don't worry about the theta at all because I don't plan on holding past, couple minutes or an hour or so, right? I'm not going into the next day with my position. So the time decay doesn't matter to me as somebody who likes to day trade, right? If you're a swing trader, meaning you're buying and selling your positions at a later date, you need to make sure the theta isn't like stupid high, right? Because time decay is gonna eat away at your contract every day you hold a contract or contracts, right? But me being a day trader or somebody who likes to day trade, I kind of do both. I will find a contract with high volume, high open interest. The delta looks cool, then I'm in the trade if the charts say it's time to buy. So complete breakdown really quick. We want high volume, we want open interest, we want Greeks, right? Look at this contract. This is a perfect example of a really good contract. Now, this is Apple. This is a $3 trillion company. They just hit $3 trillion market cap. Their volume open interest is always going to be high for their contracts because of who they are, right? So 28,000, 8,328 between volume and open interest, that's what it's going to be. That's a really high, really high volume, really high open interest. Greeks look good, delta looks solid, gamma, we're not going to really expect the gamma to be as high as the delta ever, but the gamma looks good. The theta is really low. So if I wanted to swing this contract, if the chart said it was a good swing, then I'm really happy with this contract. If I want to day trade this company, it's cool too because the volume, the open interest for this contract, the Greeks are, everything is good, right? So this is a really good example. Like I said, don't get too caught up with other companies. Like, for some companies, a 2,000 volume on a contract, or 1,000 open interest, or maybe something maybe 900. That may be high for that stock, for that company, for that contract. So now that you know how to choose a good contract, now we need to know how to use the charts to let us know when to buy the contract, because if you don't know when to buy it, then it's pointless anyway. So if you enjoyed this video, please like, subscribe down below. Any questions at all, please leave them down below in the comments, and I'll be happy to answer them as usual. I will come back with another video pretty soon. Like I said, I'm putting my whole course on YouTube now, so I'm super excited to give you guys some free game. I will see you in the next video.